Imagine that the richest investor in the world, owner of a fortune of almost $80 billion, who has donated more than $25 billion to charity, recommends a book to you and says that it is by far the best investment book ever written. What would you do with this information? If I were you, I'd at least stay on YouTube until the end of this video, since I'm going to talk about exactly that. Today, we're going to summarize the best investment book ever written, called The Intelligent Investor by Benjamin Graham. It's such a good book that Warren Buffett wrote the foreword for it. Buffett said that he read the first edition of this book in 1950. At the time, he was only 19 and thought it was the best investment book ever written, and to this day, he hasn't changed his mind. Imagine that you buy a stake in a business for $10,000 and that every day one of your partners, called Mr. Market, who is very helpful, decides to tell you what he thinks your stake is worth and also offers to buy it from you or sell you an additional stake at the price he tells you. Most of the time, his idea of value seems justified by the prospects of your business, but in some periods, he either gets very excited and wants to pay a much higher price than the fundamentals of the business say. And in other periods, the opposite happens. He gets extremely depressed and puts an extremely low value on your business. If you're a smart investor, would you let the market influence your opinion on the value of your stake? Mr. Market is an analogy of what apps and stock sites are today. It's easy to be influenced by stock quotes when you look at them all the time. It's easy to get caught up in the hype and buy high, or get caught up in the gloom and sell low. You have two options. You can get lost listening to the market's advice all the time, or you can learn to deal with it. It's essential to have emotional control and knowledge of your own investments to be able to do the opposite, selling to him when he cuts the deal at a ridiculously high price, and buying from him when his price is below. What the book advises us is this: only invest if you're comfortable enough to hold the shares in the short term. It doesn't matter if their price falls 50% or rises 100% in the short term. In the short term, the market is a ballot box, but in the long term, it's a scale. The author brings this up right at the beginning of the book because he knows that this is where the main problem lies for those who start investing. The idea that you can make money quickly, that everyone can read better than the market, is simply a lie. If the market is the average of all investors, then naturally, there are those who are going to do better, those who are going to do worse, and a high chance of being close to that average. If you want to make a quick buck, you're going to have to take big risks that could lead to ruin. And what is the market average? Over the last 10 years, the stock market has seen an average annual appreciation of 10%. So that's the basic rate that the intelligent investor needs to aim for first, while the desirable lower limit is inflation, which has been around 5% for the last 10 years. Returns below inflation are in fact a loss of purchasing power, which is what no one wants from their investments. Now, if we take a look at the list of the greatest investors of all time, what sets them apart from the rest of us is not their staggering returns of, say, 100% a year, but rather their ability to maintain high returns of around 20% a year for decades. And it is in this range of returns, between inflation and the earnings of the great investors, that the intelligent investor places his expectations. For the book, there are only two types of intelligent investor: the defensive investor and the investor and entrepreneur. While the defensive investor is someone who works in other areas, they don't have time to really delve into analysis. The entrepreneur is the opposite. He's the one who spends hours and hours doing analysis to arrive at estimates of the value of companies. It's so important, to decide what kind of investor you want to be before you start investing. If you don't have a lot of time to analyze companies and break down every detail, which I believe is the option of 99% of the people watching this video, then you should be a defensive investor. And the book gives us 6 of the objectives we should follow. 1. Diversification. If you only have 2 businesses and one of them fails, you've lost 50% of your assets. Now, if you have 20 businesses and one of them fails, you'll still have 95% of your business. 2. Exclusion of small companies. They are subject to more than normal adversity, which can either help or hinder them a lot. And since our primary objective is to protect our money, it's best to stay away from these companies, which make less than $1 billion a year. 3. Search for a strong financial condition. Companies that are not so heavily indebted and have current assets that can be converted into cash in the short term, that is. This measures whether the company has sufficient resources to meet its short-term obligations. 4. Profit. Choose companies that have made a profit in recent years. 5. Dividends. Choose companies that pay dividends every year. 6. Pay cheaply for them. The book recommends a price-earnings ratio of less than 15 and a price of less than 1.5 times its equity value. But be aware that this book was written a long time ago and for the United States. And when I first looked at this list, I thought that this was being extremely defensive and that I wouldn't do such a thing since it practically excludes all the stocks so much talked about by most people here on the internet. With time and digesting the book more and more, I understand why Graham made the list. Before you want to disagree with this advice, first understand it completely. There is a story that the monarch of the East ordered his wise men to invent a phrase that would be seen by everyone and that should always be appropriate and true. After some time, the wise men came up with the words, "This too shall pass." What a phrase, a blow to pride and consolation in times of distress. And if there were a similar challenge for investment secrets, it would be wise to sum it up in 3 words: margin of safety. And the margin of safety comes from the principle that no one has all the knowledge in the world and that no one can predict the future. Skyscrapers are built with more steel in their structures than calculations predict. Airplanes are built with more backup systems than they theoretically need. And that's how your investment portfolio needs to be built too. This is how the intelligent investor thinks. He puts all the odds in his favor. In the short term, anything can happen. And by probability, there will always be someone who claims to be very good, but was just lucky. Now, for the long term, to have concrete results, you need to be a smart investor, a big hug, and be a better person.